Hi everyone, Rich Saperstein here, Chief Investment Officer of Treasury Partners, January 8th, 2026. Today I'm going to talk about U.S. versus non-U.S. developed market stocks. As everyone knows, we have been relatively underweight non-U.S. developed market equities and have had no exposure to emerging markets really since 2008. Our view coming out of the financial crisis was that having one central bank, one monetary policy, and a fiscal policy will lead to greater coordination and a recovery from the great financial crisis. And that actually has continued in our thinking. The first chart showing the cycle of equity outperformance, if you look at the period of time going back to really the early 90s, there's only been one period where the non-U.S. equity markets have outperformed the U.S., and that is from 2002 to 2008. After that, from 2008, when we made this very significant tactical change, the non-U.S. equities have underperformed the U.S. equities. Part of the reason is growth rates, and the green line represents Japan, the red line UK, the yellow line Eurozone, and the blue line the U.S. And you can see how the U.S. has really outperformed in terms of growth since 2019. These other developed market equities. Part of the reason why the equities have underperformed is that the growth rates have clearly lagged the U.S. In order of magnitude, the U.S. GDP dwarfs those of all the other developed market countries. So from a relevancy standpoint, for a global investor, there are way more relevant, large, growing companies in the U.S. markets, which is a function of the largest GDP for global investors. And that really, you can see it drilling down where we have four companies that are effectively at or above the entire market cap of UK, France, and Germany's entire stock market. Finally, if we look at the 1, 3, 5, and 10-year returns of the S&P, the NASDAQ, the small cap stocks, the Russell 2000 versus the the all world index ex-US and an emerging market index, you can see the historic outperformance in another way over the 3, 5, and 10-year period. Now, in the last 12 months, the non-US equities have outperformed the US, and that's largely a function of the dollar declining, translating into higher returns by owning non-U.S. equities in non-U.S. currencies. Going forward, we expect to continue our positioning. We see no changes that are necessary. I like to say that you don't have to leave fish to find fish, and we have a lot of fish to own in the U.S. markets. So we'll be staying with our current allocations into 2026 by effectively maintaining roughly around 10% of equity exposure in non-U.S. developed market stocks.